Okay, we are live.
Okay, so welcome to the June edition of the CAFFE seminar series. Today, we're delighted to welcome two excellent speakers on the topic of monetary policy and finance, both out of London. Cynthia May Balloch from the London School of Economics will present Making Sense of Negative Nominal Interest Rates. Marco Grotteria from the London Business School will give a paper entitled Monetary Policy Wedges and the Long-Term Liabilities of Households and Firms. So thank you, Cynthia and Marco, for accepting our invitation. So each presentation will last 25 minutes, followed by 10 minutes of Q&A, and there will be a final 5-minute discussion at the end. So we encourage you to turn on your cameras. And Cynthia, the screen is all yours.
Great, thank you. I will share my screen. Okay, great. So you guys can see the slides, yes? Perfect.
Yes.
All right, so as Laurent said, this paper is titled Making Sense of Negative Nominal Interest Rates. It's joint work with Yan Kobe at Brown University and Mauricio Ulate at the San Francisco Fed. It's important to say that the views expressed in this paper do not reflect the views of the San Francisco Fed or the Federal Reserve System. All right. So the motivation behind this paper is the fact that several advanced economies have implemented negative nominal interest rates over the past 20 years. Previously, people were under the impression that perhaps there was a zero lower bound. We wouldn't be able to lower rates below zero. And in fact, that's not been the case. So as rates became very low, policymakers wanted to provide further monetary accommodation, and in so doing, set rates into negative territory. This is kind of joined with the observation that over these periods, negative rates seem to weigh quite heavily on banks in particular. So we really are trying to answer three related questions in this paper. We're trying to assess how useful negative nominal interest rates are as a policy tool. We want to understand what evidence we have for the mechanisms that drive its effectiveness. And jointly, we want to kind of try to look at the many, many papers that have been written in this area and try to make sense of many different disparate results. So this is a survey paper, but we think that it is a useful survey paper and that it's a useful framework for thinking about these four kind of questions. The first question that we want to take a stand on is the theoretical channels by which negative nominal interest rates affect banks. We want to have those channels in mind to be able to interpret the kind of mountain of empirical evidence that there exists on bank outcomes in negative nominal rate environments. Then we think it's important to keep in mind that there can be also aggregate transmission mechanisms that are at play behind what's happening in the banking system and that may moderate some of the effects that are measured in banking papers. And then finally, what we do is we look at the several general equilibrium models that have been written to think about the aggregate impact of negative nominal interest rates and think about what those models predict in the context of the types of channels that we think are moving around. So just to really quickly summarize what we find, we highlight a number of theoretical channels that we think affect banks. These either affect bank profitability, so these can be things like deposit margins and deposit franchise values or capital gains, and a number of channels that affect bank lending either because bank profitability is changing or otherwise. So this could be something like reaching for yield. With the theoretical channels affecting banks in mind, we turn to the empirical evidence in terms of bank outcomes, and we'll show that across a number of different papers, across a number of different identification strategies, and across a number of different time periods, we find that the effects on bank profitability of negative nominal interest rates do appear to be negative. There are more mixed results on bank lending and on bank risk, and we can interpret that in terms of the channels that we describe in the first section. So in the background of any of these papers that look at banking systems, there are also a number of aggregate transmission mechanisms that are active. These are kind of the channels by which we expect interest rate cuts or interest rate hikes to have an impact on economies generally. And we make a distinction between these channels in terms of which ones we think become weaker in negative territory and which ones potentially become stronger. So intratemporal substitution and investment channels may get weaker in negative territory, and the signaling, wealth effects, or exchange rate channels may get stronger in negative territory. Then, with that context in mind, we turn to these general equilibrium models, and we show that the general equilibrium models generally predict that negative nominal interest rates can have positive effects in the short run. So they can be a useful policy tool, but it really depends on the channels that are included in the models, the level of rates, and the horizon over which negative rates are being implemented. So I think it's an important caveat just to make clear preemptively that we know that since 2022, nominal interest rates have risen in the US and Europe and in Japan. It's really unfortunate that I didn't publish this paper before that. A reasonable question is to ask whether any of this is relevant now that interest rates are no longer negative. And what we'll argue is that this framework still is useful, and that there are some interesting ways in which we can use these frameworks to try to think about some of the fragilities in the banking sector that have emerged since 2022. So I'll hopefully have a little bit of time to touch on that. Okay, so the way that this talk will be structured is I'll talk through this kind of 4 sections of the paper. We'll first look at the theoretical bank channels, then we'll look at the empirical evidence on bank outcomes, we'll look at the aggregate channels, and then we'll look at the aggregate papers. In terms of thinking about theoretical bank channels, the kind of objects that we want to have in mind are bank profitability and bank lending. To fix ideas, I think it's important to kind of have in mind what the balance sheet of a typical bank looks like. So we can think of a stylized bank as having assets that could be like reserves, securities, or loans, and liabilities that could be deposits and wholesale funding, and then some equity on the balance sheet as well. The main macro outcome of interest is often bank lending, but in order to understand what's happening to bank lending, we first have to think about bank profitability. So kind of one way to model banks is to think that they would have market power in loans and deposits, but they would be price takers in these other markets. And if you earned kind of the interest rate I on reserves and securities, and you pay the interest rate I on wholesale funding, but you're able to earn a spread on loans and charge a spread on deposits, the net interest income of a bank can be written down as the sum of the interest margin that banks earn on their lending book multiplied by the amount of loans that they make, plus the interest margin that they earn on their deposit book multiplied by the amount of deposits that they make. So banks would be maximizing their net interest income, or their net income net of costs and subject to some constraints. The difference between the concept of net interest income and net income would be that net income could include capital gains, it would be net of costs, and it could include other categories of non-interest income at the bank level. So in terms of the channels that could potentially affect bank profitability in a negative nominal interest rate environment, we really focus on 4. So the first kind of main channel that affects bank profitability in a negative nominal interest rate environment is the deposit margin channel. This is because banks are not able to charge as high of a spread on deposits when interest rates become low, and in particular when interest rates become negative, because households are able to move their money out of the banking sector and into cash, which is not going to charge them a negative spread. So because the bank's deposit margin is being compressed when interest rates become low and as interest rates go negative, this is going to reduce bank profitability, both in the short run and in the long run. So this is really a very important channel that we focus on and that we'll continue to come back through to in relating to the empirical papers and the general equilibrium papers, because this is the main channel by which interest rate cuts into negative territory have a different effect when rates are negative versus when rates are positive. The other channels that affect bank profitability go in the opposite direction and are the typical channels that we think about affecting banks when interest rates are in positive territory. So these include capital gains, which can be driven by maturity mismatch or long-lived securities. This typically helps banks as interest rates are cut and is actually going to help banks more when interest rates are low or negative because of convexity. So this is important as something that is going to work against the deposit margin channel and that could potentially overturn it in theory. But in contrast to the deposit margin channel, really the capital gains channel is only going to be active in the short run. So deposit margins are going to collapse in the long run and capital gains are going to increase only in the short run. Similarly, there are going to be some general equilibrium effects of an interest rate cut. If the rate cut stimulates the economy, loan demand might rise. There may be lower default rates. There may be lower loan loss provisions. This is something that's only going to help banks' profitability in the short run. And then lastly, banks could change their business models. They could become kind of riskier institutions. They could increase their fee-based lines of business. These are changes that could potentially help banks improve their profitability in reaction to the collapse of their deposit margins in the long run. So really, what I want you to take away from this framework is that we have kind of the usual effects that we think that interest rate cuts can have on a bank. Typically, these cuts have positive effects on banks, but as interest rates become low or negative, the deposit margin channel becomes active and is something that reduces bank profitability. And importantly, this deposit margin channel is going to be active both in the short run and in the long run. So once we understand the effects on bank profitability using the balance of those four channels, we can then think about how bank profitability is linked to bank lending. If we think in a stylized bank framework, equity is going to evolve according to some process that involves their net income. And we often assume that equity is important for lending, and it can be important for lending via kind of three potential channels. So in a world where there are regulatory restrictions that banks can only lend up to some multiple of their equity, there may be kind of risk-bearing constraints on banks, or in economies in which banks have moral hazard problems, there could be balance sheet constraints on banks. Both of these things are going to limit the size of banks to some multiple of banks' equity. Those types of things would cause lending to fall when interest rates are cut into negative territory if their equity is being negatively affected by the fact that their profitability is falling. In contrast to that, you could also have a setting in which banks are reaching for yield, in which their lending goes up because they don't have much skin in the game and they want to take greater risk to try to earn some potential payoff. So these types of channels exist and kind of go in opposite effects in terms of their predictions for bank lending. There are also channels by which lending can be affected that are unrelated to bank profitability. These include like an opportunity cost of lending channel if there are excess reserves that are paying a negative rate and the negative rate is cut. Banks may see the opportunity cost of lending as being quite low and make additional loans. This is if banks hold excess reserves. If banks don't hold excess reserves, you can also get some transmission through what we refer to as a funding rate channel. This is relevant if banks have to raise funds to make new loans and it becomes cheaper for them to raise new funds. They would be potentially willing to increase lending. And then lastly, the potential for deposit supply to change. This is going to depend on the household savings problem. If households are moving a lot of deposits to cash, or if they're bringing a lot of deposits into the banking system, this can affect bank lending as well. So these are kind of the ways in which we think that potentially bank profitability and bank lending might change in response to interest rate cuts in negative territory. And we've drawn kind of a picture of this here where the things that would weigh negatively on bank profitability or lending are in red. The things that we think would be positive for these outcomes are in green, and the deposit light channel could go in a number of different ways. And so we've kind of made it multicolor. We'll come back to that in a second. So what I would like to do now is kind of take this framework that I've described and use that framework to think about the many, many papers that have been written in kind of empirical banking, thinking about the effect of negative nominal interest rates on banks. There are a lot of papers. So we have read them all. They're all listed here. If you have one that isn't here and you'd like me to add it, please send it along. I'm glad to read more of these. But we can think about this evidence very broadly in terms of kind of the differences in identification strategies that are used, the different outcomes that are studied, kind of the number of banks in the sample, and then what exactly is being done in terms of the identification strategy for each paper. I don't have enough time to talk about this all in detail, so I'll go quite quickly through this to kind of bring some general lessons from the papers overall. When we think about the different identification strategies, these papers are broadly in kind of three groups. Either they are cross-country regressions, in which there is an assumption of co-movement across the economies, and there is a time-fixed effect that takes out kind of the macroeconomic cycle across countries. There are within-country studies that look at banks by how exposed they are to the negative nominal interest rate environment, and there are high-frequency identification papers that are going to be more like what Marco presents later today that look at asset prices. So when we look kind of first at the cross-country regressions, the papers are all different, but if we look at how these papers kind of tell us what is happening to banks in general when interest rates are cut into negative territory, we see a fairly consistent message. Bank profitability seems to decline, if potentially weakly in some settings, but consistently across the papers, bank profitability declines when interest rates are cut into negative territory. This deposit margin channel is a real thing, and it tends to be larger than the other positive channels that would go in a positive direction. The results that we get for bank lending and bank risk-taking are a little bit more mixed. We can see this story as well through the within-country studies that use measures of bank exposure. Now, when we use measures of bank exposure, the measures of exposure allow us to shed light on exactly which channels are active in what quantities. So here we see again that profitability declines across kind of all of the studies by measures of bank exposure. And the measures of bank exposure are typically linked to the size of bank's deposit franchise or the extent of bank's market power. And so we think that this is evidence that is consistent with the deposit margin channel being large and in particular larger than the other channels that would go the other way. Now, that said, we do find a number of settings in which lending increases and potentially bank risk-taking in lending increases. And we see these papers as kind of shedding light on the importance of both risk-bearing in some settings and the opportunity cost channel or reaching for yield in other settings. So these papers really show us kind of which of the channels that we said could potentially be active are working. And inside the high frequency studies using asset prices, we do find kind of similar effects. So there's kind of 5 things that we take away from these empirical papers. If you don't want to read them all, the kind of main things that we think we learn from having read many of them is that deposit profitability declines when nominal interest rates are negative. This affects some banks more than others. It is increasingly costly for banks to hold excess reserves under negative rate environments. There are expansionary effects on lending, at least initially, although in a number of settings, it's noted that the longer run effects on lending are potentially detrimental. And kind of behind all of these studies, we do have an aggregate environment that's active that's not necessarily salient in those papers. But I'll turn now to this aggregate environment and try to explain why it is that this could potentially muddy the interpretation of some of the previous papers. So the theoretical aggregate transmission channels that we think are important to keep in mind in thinking about the transmission of negative nominal interest rates are 5. So I've taken kind of the picture that I drew of bank profitability and bank lending at the top, and I've added aggregate transmission channels to the bottom. The channels that we'll focus on in this paper are 5. They're the intertemporal substitution channel and the investment channel, and then signaling, wealth effects, or exchange rates. So intertemporal substitution and investment, as I said in the introduction, we expect might be weaker in negative nominal interest rate environments. But these other channels we think could be active as they usually are, and potentially stronger when interest rates are negative. So the intertemporal substitution channel is going to really depend on the interest rate in households' Euler equation. If we think that the relevant interest rate in a household Euler equation is going to be mediated by banks, for example, if banks have an impact on deposit rates or if they have an impact on lending rates that households face, this could potentially become weaker as rates go negative. I think Marco will argue that banks are not that relevant in terms of transmission to some of these channels. And in that case, we would expect the direction of this effect to be positive and kind of not any different than it would be in positive territory. But if we do have some intermediation by banks that matters to households and matters to household savings, we do expect that this channel would weaken. Similarly, investment, to the extent that firms depend on banks in order to be able to borrow and invest, we think that this evidence that we have at the banking level could potentially mean that banks are less stimulated to invest by a cut of negative interest rates, a cut of interest rates in negative territory than they are when rates are in positive territory. Of course, if banks borrow outside of the banking system and transmission is not at all affected by any sort of frictions like the ones that we've described, then this channel would be active as usual as you cut rates into negative territory. The signaling channel is something in which negative policy rates potentially signal prolonged environments of low rates. This is particularly important in negative territory, and it may be particularly pronounced the first time negative rates are implemented. Similarly, wealth effects exist when you cut rates. They're potentially stronger in a negative rate environment because of convexity. Lastly, kind of the exchange rate channel is there. It should be active as usual. We don't normally include it in macro models, but I think it is important to note. And it's been particularly important in some environments, such as in Switzerland. So there are a couple other channels that I won't mention here. I'll use my last few minutes to talk about the general equilibrium models in this literature. There are several of them. And the way that we organize our thinking about these papers is to line them all up and to include with the little colored boxes the channels that we've described above and the direction in which the channel has an effect in each one of the theoretical papers that's been written on this topic. So there's quite a lot of information here. Let me try to summarize. There's kind of one paper by Matthew Ragnley that really focuses on the intertemporal substitution channel and shows that this can be something that has positive effects when interest rates are cut in negative territory. Aside from his paper, all of the papers that have written that think about the aggregate effect of negative nominal interest rates really focus on carefully modeling banks, and importantly, including the effects of this deposit margin channel on bank profitability. The papers differ in terms of which ones of the other bank channels are included, but most of them include a capital gains channel, especially if they're thinking about the short run. In the long run, the capital gains channel isn't relevant. Most of them think about general equilibrium effects. In the long run, those are not going to be relevant. None of the models really incorporate the potential for changing business models or the potential that banks would reach for yield. Now, the data and the calibrations in all of these papers differ quite substantially. So we would expect to find slightly different results across the papers. We also note that some of the channels that we've noted might be important are being excluded altogether. These are, for the most part, channels that are going to help negative rates have a positive effect. So it's interesting to note that in spite of having excluded some of those channels, the kind of general consensus across the papers is that negative nominal interest rates can be effective at stimulating the economy, particularly when they're introduced initially and for a relatively short period of time. So this is something that is found across the first 5 papers that include Mauricio Ulate's AER paper, the reversal rate paper by Marcus Brunemeyer and Jan Kobe, and 2 other papers by De Groot and Haas and Onofre et al. The kind of caveat to that is that over time, we might expect the effectiveness of negative nominal interest rates to wane. And in kind of a long run steady state, the effects that this might have on an economy could be negative. And this is in particular because we expect this deposit margin channel to be a persistent effect. And some of these other effects that are going to be positive are going to be more active only in the short run. Okay. So this is a quick overview of this paper. To conclude, what we take away from the broad literature on negative nominal interest rates is that we see kind of a general picture in which negative nominal interest rates are negative for bank profitability, but that they can stimulate bank lending, particularly in the short run. And because of this short run stimulative effect, we do think that in the aggregate, this is a relevant policy tool that policymakers should continue to kind of keep in the toolbox should interest rates become low and close to the zero lower bound again. This, I think, has to be kind of caveated with the idea that this is a short-term tool that potentially is problematic if it's implemented for long periods of time. And then kind of to come back to this idea that now rates are no longer negative, maybe we don't need to worry about this. What I would say is that we would, of course, expect deposit margins to improve. This is the main channel we were worried about in this paper. We think that that problem will hopefully go away. However, what's happening in the background with deposit supply and household decisions does not necessarily mean that banks are going to get consistent deposits from households that are now looking over a range of asset classes in order to make investments. And this kind of fragility had been highlighted in March of last year with the failure of a number of banks in the US. So there's a number of open issues and areas for future work, but we kind of enjoyed thinking about this, and I hope you enjoyed hearing about it. We'd be glad to hear any questions or comments that you have.
Yeah, so thank you, Cynthia, for this very clear and interesting presentation. Do we have questions from the audience?
So, Cynthia, can I ask, like, what are the implications for asset managers? So if I manage money, and now I realize that interest rates can be negative, then how should I change what I do with the funds I manage?
So if you realize that interest rates can be negative on the funds that you manage and you're an asset manager, how would that change?
Yeah, like I realized that what I thought was unlikely, that bank rates become negative, now is no longer unlikely. So how should I change my asset management position?
So I think that that's a tricky question. But what I guess I think the broad advice that would come out of this framework would be that this does seem something that is quite uniquely problematic for the financial sector.
Mm-hmm.
And in particular is problematic for deposit-taking institutions. So you would want to be careful about overweighting that sector in an environment where you thought that a negative policy rate was likely.
And for insurers, like, how would they suffer from negative interest rates?
Okay, so this I have listed as like areas for future work. I
Yeah.
haven't thought that much about it. But typically insurers have the opposite problem, right? So their issues with solvency arise when rates are high rather than when rates are low, because they typically have long dated liabilities and relatively short dated assets.
Mm-hmm.
I think that for insurers, the calculus here has more to do with managing potential solvency risk when rates become low, and then how it is that they need to think about liquidity risk when rates begin to rise again.
The reason I asked the question is because the Bank of England has very detailed data on the holdings of insurance companies. So for regulatory reasons in the UK, insurers have to report everything, every transaction that they do. So you could actually see how their vulnerability changed during the negative interest rate period.
Mm-hmm. Yes, and I know my colleague Joe Hazel and a few people at the Bank of England have been really focused on looking at this data insofar as it affects insurers in the UK.
Yeah.
I think what they find is that as interest rates became negative, because banks were worried about potential solvency issues, they entered into kind of a lot of these derivative transactions that would help them hedge the solvency risk.
Nice.
However, as rates rise, those swaps typically required significantly large margins to be posted.
Yes. Yeah.
And that led to concerns about liquidity at the insurers at a time where their solvency is improving, because their solvency gets better as rates rise. It's the opposite of banks. But they had all of these kind of liability-driven investments and other derivative positions that needed to have kind of margin posted in a rising rate environment.
Thank you.
I have a small question. So in the Netherlands, in 2022, if I'm not mistaken, these negative interest rates were passed down to depositors, not to all depositors. It was above 100,000, but quite a few banks did it. So there was, what you saw is that people were not going into cash. They were switching a bit between banks, but at one point you were sort of like all switched out. This would change your conclusions and like think about effectiveness of monetary policy to a large degree, right?
So if households were insensitive to earning negative deposit rates, because they
saw
don't
actually rather,
But-
yeah, which you saw in the Netherlands, yeah.
Yeah, okay. What I think that would imply is that there's kind of a transfer from households to banks that helps kind of alleviate this problem in some sense. I would point out that over the long run, what we've seen, for example, in Japan is that the kind of share of cash in household savings does increase gradually. People become kind of more and more accustomed to saving in cash when they recognize that they're earning kind of a negative yield on their deposits at banks. So in the aggregate, what we've seen kind of in the household portfolio is that the share of cash in financial assets has gone from 4% to about 11%, which is significant if you think about keeping 11% of your savings in cash. To kind of add to that, I do think that there are other ways that have been proposed to kind of alleviate the extent to which this weighs on the banking system. So, for example, in the implementation of negative nominal interest rates, a number of countries have implemented a tiering system where they're only charging negative rates on kind of a portion of reserves to try to make this a little bit less painful for banks. Similarly, there have been proposals by Ken Rogoff, among others, to tax cash. And then kind of when you go to the ATM, you kind of have to pay a tax to get the money out, or you have to pay a tax to get the money in. And that's going to kind of increase households' proclivity to kind of keep money in the deposit system. So there are a number of tools, like in the paper that I have with Yan on Japan, we have kind of evaluate the quantitative effectiveness of those measures. There kind of are a number of complementary things that policymakers do to try to alleviate this once they understand the extent to which it's a concern.
Thank you so much. It's very interesting.
Cynthia, I had maybe one last question. You did not mention aggregate prices as one of the aggregate implications of negative interest rates. Is that because there is no effect, or is it just something that wasn't part of it, that it wasn't within the scope of your study?
So, of course, there can be an impact on prices, and that's, I think, an important thing to think about as we think about the difference between short run and long run effects, right? Because in the short run, kind of in a new Keynesian framework, we don't think that there's going to be much of an impact on prices. In the long run, we would think that prices will adjust. But in terms of how that would relate to this framework, I think it's a little bit outside of the framework. That's a good thing for us to try to think about adding in.
Okay, well, thank you very much. It was really a fascinating presentation. We can move on to the next paper. So Marco, the floor is yours.
Thank you so much. Can you hear me?
Yes, very well.
Perfect. So thank you for inviting me. Today I'm going to present, monetary policy wedges, the impact of monetary policy on long-term liabilities of households and firms, which is a joint work with Jules van Binsbergen. So understanding the type of wedges that are important for monetary policy transmission is actually key if someone wants to evaluate several economic theories, or if just want to assess the implication of policies, so for policymakers. Among these wedges, as Cynthia has nicely mentioned, is for sure lending market power, which is thought to affect the sensitivity of mortgage rates to monetary policy. So in this paper, what we're going to do, we're going to have a comprehensive assessment of all the type of monetary policy wedges that people have before us have proposed in the literature, but most importantly, we will actually quantify the drivers of monetary policy transmission to private rates that truly matter to households and firms. And among these rates, there is clearly like mortgages and corporate bond yields. And in fact, the central banks only can have an impact on the macroeconomy so far as they can have any impact on these prices that truly matter to households and firms' decisions. And so what we actually do in the paper, we're going to provide a novel answer to the fundamental question of how does monetary policy actually affects these prices, these private rates, by first showing that if you use the commonly used proxies of monetary policy shocks that people so far have actually computed, like Kuttner or Nakamura and Steinson, you will be unable to fully capture monetary policy transmission. And this is basically due to a very misconception of how monetary policy, I think, works, because those shocks are computed based on high frequency changes in rates up to 1 year around the FOMC statement releases only. And so what we actually show in the paper is that what is important is, first of all, to look at the benchmark rates that banks themselves advertise to use when pricing or hedging, which for our case will be actually swap rates, and in particular 10-year swap rates, and I will discuss why. And then you should not only look at the narrow window around the FOMC statement release, but you should also include, for instance, the press conference, which since 2011 have become a key policy tool with which the Federal Reserve actually does monetary policy in the US. And so by proposing our new measure of monetary policy shocks, we actually show that there is a complete transmission of monetary policy to primary mortgage rates and secondary market bond yields. And again, as Cynthia has actually anticipated before, our argument is that a lot of wages disappear once you correctly compute the shock to begin with. So what do we do in the paper? We first of all combine detailed data sets on prices of households and firms' liability with the very standard discontinuity-based identification approach that is commonly used in monetary economics and that exploits the fact that monetary policy news is usually communicated in a lumpy way to investors around these announcements. So you can actually look at price changes or like changes in rates around this very narrow window around the announcements. And that's what we're going to do. This is the high frequency identification approach we're going to use. We're going to combine this identification approach with 30-year fixed rate mortgage, which are the most common type of mortgages in the US. Survey rates from RateWatch and bankrate.com. This will be extremely helpful for us, more for the paper than for the presentation, because I will not have the time to go through this in the presentation. But it will be very important for us, especially to disentangle some wages, which may be related to prepayment value option, for instance. And then for the corporate sides, we're actually going to look both at the transaction of non-financial corporate bonds from traces and CDS spreads from market. Importantly, we're going to try to argue that most of the monetary policy transmission for corporate bond yields has actually gone through changes in credit spreads. And this is why introducing also CDS spreads directly into our analysis would be important. Now, again, we're going to construct monetary policy surprises using changes in long-term swap rates over a narrow window that importantly includes both the statement release and the press conference. So what do we show? We actually show that mortgage rates respond 1-for-1 to changes in the 10-year swap rates around this very narrow window. But actually, we show that if you use like Nakamura, Steinson, or Kuttner shock, there is a disconnect between the mortgage rate and the short-term policy rates. And then, if you use those, we're going to spend years thinking about all the type of wedges and the type of actually economic theories that can explain those very puzzling patterns that they're going to show you, which again are simply due to the fact that, you are incorrectly defining the shock that is relevant to these private rates. And so using our 10-year swap rates, we're going to show that the one-for-one response is actually explained equally by expected short-term rates and term premium, and much less so by convenience yield, although they still show up significantly. On the other hand, we show exactly no or extremely limited role for wedges such as lending market power at the local level, or adverse selection of borrowers after monetary policy announcements, or finally changes in the value prepayment option. For corporate bonds, we show that unlike mortgage rates, which are highly collateralized, and so like the majority of the movements that we're going to capture would be effectively interest rate movements, like corporate bonds are unsecured, and like most of the variation is actually driven by credit spreads. And so the monetary policy transmission to corporate bond markets in the past 2 decades has actually mainly worked through changes in credit spreads. In fact, we're going to show that there's going to be an asymmetric response, unlike mortgage rates, for which we show a one-to-one response to both positive and negative monetary policy shocks. For corporate bonds, we're going to show an asymmetric response. We're going to show that when the Federal Reserves lower 10-year rates, affecting this very narrow window, what happens is that the corporate bond yields go down more than the amount they're going to increase. And this is especially driven by changes in credit spreads. Now, here I'm going to show that term premium explains the majority of the response, and the limited role is driven by expected short rates. Finally, in a part that is not in this presentation, but is in the paper, we actually try to understand the relation between monetary policy shocks and bank net worth. And we're going to actually show that unlike some of the literature that has argued that banks do maturity transformation without interest rate risk, we actually find an exposure, but it's a positive exposure. And so banking industry is highly exposed to shock to long-term rates, but positively. And so a 1 percentage point positive surprise to this 10-year swap rate is actually related to a 7.29% positive stock returns for the banking industry that have the largest exposure across all industries. And so this result is actually explained entirely by a cash flow channel, for which, this fraction that loan actually that reprice in the next 12 months explain the largest portion of the variation. So in terms of structure of the talk, I will first provide a brief motivation on why you should use the long-term swap rates changes when trying to think about transmission to private rates, rather than the standard Kuttner or Nakamura and Steinson, or, we also try with Hanson and Stein and a bunch of other shocks in the paper. Then we're going to evaluate directly the monetary policy implication on households and firms' liability. And finally, I will try to say something about the decomposition if time allows. So the first, plot before even entering the monetary policy transmission part is actually just plotting the 10-year swap rates, which is this red line in the figure from 2000 to 2020, the effective funds rate, which is thought to be the direct target rate for monetary policy purposes, which is the green line, against the 30-year mortgage rates. And so these are actually transactions. These are actual mortgage. And the date of the mortgage is the date in which the deed is signed, which is in fact our data. So we have about, I think, 7 million mortgages in these plots. You cannot probably see, it looks like a shaded area, but each of the, it's just a bunch of plots. And so what you can actually see is that these mortgage rates follows very closely the 10-year swap rates and much less so the effective Fed funds rates. Again, this is exactly because the swap rate is actually the rate that banks use when pricing and hedging mortgages, okay? And the 10-year is chosen because it matches the duration of the 30-year mortgages. And in fact, the 30-year MBS usually has a duration that is between the 5 and the 10-year, but much closer to the 10-year swap rates. Now, again, swap rates are these benchmark rates, and they're also using, as I was mentioning before, for hedging purposes. Think about Fannie Mae's. Like in the 10K, they wrote that in measuring the estimated impact of changes in the level of interest rates, they just assume parallel shifts in all maturity for this US LIBOR interest rate swap curve, which is in fact what we're going to use, and that's because of the sample that we work on. So it's standard industry practice to average the 5 and the 10-year swap rates when hedging these products, and we're going to use the 10-year swap rates because it has the closest maturity. You can do exactly the same plot, but now rather than mortgage rates, you can actually have corporate bond yields. Now, what you can see here is that the low end, like the lower bound of these corporate bond yields day by day, is actually extremely close to the 10-year rates. But, you know, there are some spikes, and those spikes will be, in fact, we will signal the importance of the credit spreads that I was mentioning before. And in fact, you can see spikes during the year of 2008, for instance, where, you know, there is a much larger increase in the credit yields paid by riskier firms. Now, why again the 10-year swap rate is actually the benchmark rate for corporate bond yields? So I used to actually be in the trading desk and for UniCredit here in Europe, and the way we were actually pricing these corporate bonds, I was working with bonds issued by financial institutions. It was very, very simple. If the bonds was a liquid bond, you were trading and pricing against the treasury curve. If that's exactly because then you are hedging interest rate risk using treasury futures. If the bond was illiquid, you were actually pricing against the swaps. And so this is again why we're going to use swap rates, and in particular 10-year rates, to understand that, you know, the relation between monetary policy and long-term corporate bond yields. So why is the distinction between, you know, the short-term monetary policy shocks and the long-term monetary policy shocks actually relevant and an extremely important distinction? And this is an example. It's July 31st, 2019. Jay Powell has, you know, a press conference, which actually was probably one of the worst for the Federal Reserve. He sent the market on a roller coaster. And so here what I'm plotting is the implied rate from 1-year Euro-dollar futures, the implied rate from the 5-year Euro-dollar futures, and the 10-year swap rates. The 2 p.m. is the time in which the Federal Reserve announced the statement. And you can see a jump in the 1-year rate, I mean, the implied rate from the 1-year contract. You can actually see that more or less the implied rate from the 5-year contract remains stable, and there is a small increase for the 10-year swap rates. What is more important for us is actually what happens in the shaded area, which is the press conference, which lasts about 1 hour. And so Jay Powell starts talking about mid-cycle adjustments to policy, and you can see that there is a further increase for the 1-year rate. There is actually some increase, but then a drop for the 5-year rates. And finally, the swap rates, I mean, despite a large movement, they actually go back to and remain constant. So what we argue here is that, again, the rates, you know, basically the Federal Reserve monetary policy, the way in which it transmits to financial markets is actually multidimensional. And so, like, it doesn't really have to move all interest rates in a level shift, with a level shift, but, you know, can also affect directly the slope of the yield curve. And so, for instance, this is a scatter plot between the changes in our 10-year interest rate swaps against the Kuttner shock, like the FF shock on the left plot, or the Nakamura-Steinson shock. So the Kuttner shock is the high frequency change in the closest month Fed funds future implied rate. And the Nakamura-Steinson shock is basically a shock to rates up to 1 year because, I mean, again, as Nakamura-Steinson say in their famous QJE paper, is they want to capture forward guidance. And so we actually are extending their logic to the, you know, to effectively like the full extent. We're saying, okay, but if we want to capture forward guidance, let's just use the rates that truly matter and that banks use themselves. And so these are actually the 10-year rates, is not rates up to 1 year. So the benchmark specification will be introduced in the next slides, but before doing that, let me actually set a little bit the notation. So MIJCFH will be the mortgage rate for borrower I in the metropolitan area code C for a 30-year mortgage, which is issued by lender J on date H around the FMC event F. So there are a lot of subscripts. This is done on purpose just to show the extreme granularity of our data. We're going to control for a set of borrower characteristics which are pretty common in the literature, including the loan-to-value ratio or the FICO score, or whether the mortgage was GSE eligible. We're going to regress it on a bunch of monetary policy shocks which includes both ours and the Nakamura-Steinson one. And we will interact our shocks with two sets of dummy. The first dummy is an indicator, which is gonna take value 1 for a given date H and 0 otherwise. The second dummy is a dummy D, which is gonna take a value 1 if the shock was positive or negative, and this will allow us to separate between transmission after a positive and a negative shock. And so this is like the regression that we're gonna run. It's a panel local projection on the Jordan. Doing so will allow us to actually control for lender by MSA, by FOMC fixed effect. And again, this will exploit to the full extent the granularity of our data. This is the main result of the paper. What you can see is that after a positive shock, which is this, this set of red triangles, there is an increase, a smooth increase, and the mortgage rates increase 1 to 1. After a negative shock, which is the set of blue circle, there is a drop in mortgage rates, and the drop in mortgage rate is also again 1 to 1. The relation, here the response is completely symmetric. We test for the difference, there is no difference. Why does it take 28 days for mortgage rates to full response? Because we're using transactions. We're using the date in which the deed is signed, and on average, it's about 28 days for the deed to be signed, after they lock the rate. Now, I don't want you to be thinking that, for instance, this is just an artificial, response of the fact that we're using swap rates. And in fact, if you just take, the changes in swap rates around the same times, 1 week before the event, and you look at the monetary deposit transmission after the next 28 days, you don't see any relation. And again, this is very much in contrast to the wonderful one-to-one relation that we actually show after a monetary policy. So there is truly an interest rate news coming around these events, and it gets transmitted to mortgage rates. Now, again, this is also in consonant to the mortgage, to transmission to the Nakamura and Steinson shock, for which, again, after a negative shock, you find a drop in mortgage rates, but after a positive shock, you find a statistically insignificant drop again of mortgage rates. And this was happening exactly because in the past 2 decades, what happened again was that the correlation between these two shocks was very weak, especially after 2010, where again, a lot of positive Nakamura and Steinson shock, positive shocks to short-term rates in this very narrow window around the FOMC statement were actually associated to drop in 10-year rates around the same window. Now, going back to Cynthia's talk, does the bank market power actually affect the transmission? Again, we're not saying it doesn't exist bank market power. If anything, we actually believe there is bank market power on the deposit market. It's just that when we look at the local lending market power, we don't really find any evidence. We measure market power in 4 ways. If you have like a 5th way, we are very much happy to include it. But so far, we measure using Herpidal-Ishman index at the 5th county level. We use the market share of the top 4 lenders in a county. We use a county level measure of excess demands because, mortgage lenders were actually telling us this is what they tend to look, which is the number of loans approved plus the number of loans rejected relative to the numbers of loans approved. And then we also compute a component of interest rate, which is just above and beyond what can be explained by borrower loan characteristics. But none of them really work. So what you actually see here, we're splitting counties by their HHI, and we are looking at the response to negative shocks. You see an identical response in both the top quintile, which in this plot is called high HHI counties, and low quintile, so the bottom quintile HHI counties. We also see the same response to a positive shock. And again, we actually document that regardless of how you can compute market power at the local level, there is no distinction between the transmission of mortgage rates in high and low concentration or high and low market power areas. Now, again, we're not saying that it doesn't exist. We're just saying that for monetary policy transmission, we don't find any difference. So then we actually try to understand how the Federal Reserve did have an impact. First, whether they have an impact, and second, how the impact worked for corporate bonds. And the beauty of working with corporate bonds is that now we can actually include a security by FOMC fixed effect. So we just need to have an observation before the FOMC and an observation after the FOMC event. And we run exactly the same regression, and this is actually what happens. So we see that corporate bond yields increase 1-to-1 after an increase in the 10-year rates, but they drop 2-to-1 after a decrease to these 10-year rates around the FOMC announcement. And again, we find that this effect seems to be even larger for speculative corporate bonds rather than, for instance, investment grades. And this actually suggests that there is a much larger role of corporate bond yields, which we document in the paper. And when we look directly at the transmission to credit spreads, what we find is that after a positive shock to 10-year rates, corporate CDS actually did not increase. While after a negative shock, corporate CDS went down, which we in fact relate to the fact that, it became probably cheaper for firms to fund themselves. And potentially the positive shock was actually also coming together with some positive economic news or some Fed signaling about the future outcomes. And again, this is very important because these monetary policy shocks are surprises with respect to the investor information set, but they are not surprising with respect, of course, to the Fed information set. And so they reflect the optimal choices of the Federal Reserve. And that's why we argue that, it's interesting and it's very important to understand how monetary policy transmits both to corporate bond yields and mortgage rates separately. Now, again, there are some key driving factors. In this presentation, I will just try to look at the expected short rates and term premium. I don't know how much time I have, but most likely very little. So we can decompose the shock.
You have about 3-4 minutes left.
Perfect. So we decompose the shock using Adrian Krump and Muenk decomposition, and we look at this, how much, changes in the 10-year swap rates was actually driven by changes in expected short-term interest rates versus term premia or the residual. And the majority of the variation is just explained by those two. And so the residual are a small component, and it's mostly actually everything. I mean, the entire residual is probably due to convenience yield, which we actually show in the paper. Now, the response to mortgage rates of mortgage rates to expected short rates is also 1-to-1. The same is for term premium. And so we can actually go even further and make a decomposition, a variance decomposition, which is very standard. And what you see is that expected short rates and term premium are equally important for mortgage rates, and they explain a large fraction of the variation, while instead term premium explain 60% of the variation in corporate bond yields, and much less so is explained by expected short rates. And again, we think this is related to the much larger role that corporate credit spreads have for transmission to corporate bond yields. So let me conclude. So in the paper, we show that short-term and long-term rates do not shift together around these monetary policy decisions, which are in fact are multidimensional. Mortgage rates have responded 1-to-1 to changes in monetary policy when computed using high-frequency changes in swap rates in narrow window that includes, again, importantly, not only the statement release, but also the press conference. And once you actually use this shock, you find no role for lending market power, potential selection of borrowers, or changes in the value prepayment option. We find that instead monetary policy have mostly worked for corporate bonds through changes in credit spreads. And overall, we argue that higher long-term rates are actually good news to banks. So thank you so much.
Thank you very much for this very clear presentation. We have a few minutes for discussion. So actually, maybe I can ask a question. I think what's very striking is you say if you look at shocks at the right maturity, then you get a 1-to-1 effect, a 1-to-1 mapping into the desired outcome. So it's almost surprising that people have not documented this before. That would be my first comment. So do you know why that's the case? And also my other comment is if you're conducting monetary policy, I mean, you only usually you have a limited set of options. Like you don't move all the rates at the same time. So even though, it's good to know that the 10-year swap rate affects mortgage rates, I mean, how in practice does that influence the conduct of monetary policy?
Absolutely. So let me answer the first question. Why did people not actually document this? So there is one paper by Gilchrist and co-author on AJ macro. They try to argue, I mean, they look at until 2014, and they from 2011 to 2014, they argue you should actually use the 10-year. But like they are the only paper, and why to start in 2011? They actually use it more broadly. Now, having said that, why people didn't use it is because actually, if you look at the Nakamura tension sample, for instance, most of the shocks were happening in level. Like, there was this idea that the Federal Reserve actually was having a direct control on the short-term rates, and then, the other rates would respond more or less in level. This is actually kind of the common outcome. Having said that, since 2011, Ben Bernanke wanted to introduce the press conferences. That's why 2011 is actually an important date. Now, why press conferences were important? Because rates were at the, at the zero lower bound. The short-term rates were at zero. And so there was a very limited commitment to changes like short-term rates and to affect expected short-term rates per se. And so what was happening there is that, the press conference were actually able to have an effect directly to the long-term end of the curve, which again is what is important for households and firms. And so while I agree with you, on one hand, it's like you say, oh, we are finance people. This is actually what you should have done. Use what the benchmark rate is. Use what, the banks themselves advertise. But then the problem is, it also depends on, first, how monetary policy works, and second, what the Fed has control. And this actually relates very well to your second question. How can the Federal Reserve have control to
Marco, don't get me wrong. I mean, the best ideas may seem obvious after the fact. So
yes, no, exactly. This is actually what, I agree with you. So I was saying, this is related to your second point, which is also very important. Does the Fed have an impact on these 10-year rates, and how? And what we believe is actually, first of all, that there are some conditions, both in macroeconomic condition and liquidity condition, in which they might affect more like the Federal Reserve impact on long-term rates. I was recently, I mentioned to you at the very beginning of this Zoom call. So I was recently discussing a very nice paper by Gabor Pintner, the LSE. And, the argument is that actually monetary policy doesn't transmit in low liquidity period. And by transmission, they actually use the transmission of short-term rates to long-term rates. And my argument is that is actually, in fact, when the Federal Reserve press conference and speeches and words matter the most. These are exactly probably the low liquidity period. And those are exactly the periods in which, the investors pay even more attention to those words. And so you actually probably expect to see what, this scatter plot that I was telling you. This scatter plot is just telling you that the correlation around this FOMC announcement between, for instance, the closest month implied rate and our shock is only 23%. And using the Nakamura tension shock is actually only 47%. And so, of course, the implication for monetary policy transmission analysis would be very different using one or the other.
Cynthia, go ahead.
Thanks. I have two questions, one maybe in this picture. I wondered if you tested this hypothesis that this works better in the kind of low interest rate environment. If you tried to split the sample in the middle,
yes.
And do you find stronger effects?
Yes,
or worse performance for the shocks?
Yes, we do. We do. So we actually test that. We do some sample analysis. And that is actually a very important point. And again, we actually think this is due especially to the introduction of press conferences. So before, in 2011, press conferences were only after the 2-day FOMC meetings. So there is a little bit of selection there. Some people might think, okay, but these 2-day FOMC meetings are also more important meetings than, the other meetings. And so, okay, fine. After 2019, you have press conferences after every meeting. So that is kind of better for the selection. and again, also for our stories. And you can see, as I was mentioning, that, you know, rates clearly responds to the press conference words. But yes.
So my second question is about the effects that you measure on the financial sector. It's like a massive effect. And so I kind of wondered whether if you were to split the sample of banks, not by bank market power, but by like the fraction of their loan book that's being repriced, would you find different dynamics?
Sorry,
in mortgage?
I might have been actually unclear. So when we actually do the analysis to study the relation between monetary policy shocks and bank stock returns, that is, first of all, it's just like a regression. So we just find that, you know, we basically regress the FAMA French industries, 49 industries against our shock, monetary policy shocks. It's a time series regression industry by industry. So that's the 7.49%. Then, however, we use individual bank level data. We don't split banks by market power. We actually split banks. We actually just control for the amount of loans that reprice within 1 year and so on and so forth. And that's where, in fact, we find the result. We argue that this is cash flow driven exactly because there is loan repricing and exactly because there are like some bonds which are repricing.
Right, but I guess my question was like, I think it would be interesting to do the exercise you do with bank market power using this measure of the fraction of loans that's being repriced.
Absolutely. I mean, we can interact the two and we can check whether it's exactly the loan being repriced simply, or, you know, the fact that some banks who have more market power may reprice more frequently the loans. I think that's what you hint. Yeah, we can definitely do that. But again, our market power story is actually at the local level. So.
Any other question?
So, Raman, you had a question?
No. I just wondered, like Cynthia had a question just as Laurent asked his question. So I wanted to make sure that she got a chance. She's the expert. It's very clear, like she knows the literature better than anyone else. I don't know what you plan to do with all this stuff, like, but it's an amazing literature view that you have. Like, I've never seen such a comprehensive analysis of the literature. So,
Well, thanks. And thanks for letting me ask my question.
yeah. Okay.
Okay, but perhaps we can wrap up the meeting. So the next. So again, I'd like to thank Cynthia and Marco for a really fantastic session today. And the next session will take place on July 9th. It will be a session on artificial intelligence and machine learning. Sergio Correa from the Federal Reserve Board and Svetlana Brizgalova from LBS will present. So see you all in a month. Thank you so much. Thank you again for a great session.
Bye.
Thank
Bye.
you. Bye.
Thank you.
Thank you.